Welcome to the Real Estate Investing Failures to Fortunes podcast, the show where we fearlessly dive into the untold stories of real estate investors' greatest setbacks and how they turned those failures into resounding successes. I'm your host, Kate Berry, and we're talking with real estate investors across the country to learn exactly how and why they failed, and how they took that failure and turned it into a powerful lesson for their business. So come along with me, Kate Berry, on this transformative journey from failure to fortune. I invite you to join our supportive community where together we can inspire, educate, and motivate each other to achieve all of our real estate investing goals. Welcome to the Real Estate Investing Failures to Fortunes podcast. I'm your host, Kate Berry, and I am here today with Irwin Boris. And Erwin has more than 30 years of experience in real estate, finance, investment, asset management. And during his professional career, he has participated as a direct lender, principal, investment banker, and advisor in more than $5 billion in real estate transactions. So Erwin, we are so glad to have you on our podcast today. We're going to get into some really interesting new concepts, at least, maybe new for the podcast, probably not new to you, but I'm really excited to dive deep.
No, thank you for having me today. And hello to all the listeners and viewers. It's been an interesting road over the last 35 years in real estate, everything from practicing as a CPA. And I guess it's where I had some exposures. My father was a real estate attorney, but practicing accounting and auditing real estate entities was interesting, but you don't really get an appreciation for that. And then I went to work for one of the firm's clients, and they made me manage, 1,000 apartments in 4 buildings in New York City. Oh, and I had to go to. Then you get to see how difficult it is. And in New York, in the larger buildings, you have unions you deal with. You have to go to landlord-tenant court to collect your rent. Deal with federal and state agencies when you might have a subsidized tenant or senior citizen. So it was really eye-opening of what those numbers meant. And through the years, I've been either working as a direct lender, lending on everything from apartment buildings, shopping centers, office buildings, industrial, and raising equity for people and trying to help people structure deals. So I've seen a lot of best practices, a lot of worst practices, a lot of practices that would make me run away from people, definitely not invest with them. And more recently, because I speak at a lot of conferences, I'm asked by people, can you help me? Can you look at something? I have a deal going sideways. And I'm happy to help people because sometimes, you have to make a capital call if you believe you're going to at least get out whole. If it costs you a couple of bucks to protect what you already have, you do it. To throw good money after bad where you don't think you're going to get any of it back doesn't pay. And the one thing I've really come to the conclusion of is that some people shouldn't have invested in the first place. They did it because maybe they were too late to the party. Mm-hmm. Some people had been doing it all along since 2010 or 11, and every deal worked out except for the last 2 years. Right. And then with the pricing increasing and interest rates moving up, I just think some of the sponsors became a lot more aggressive on their assumptions. And I actually did get on the phone with one of the investor relations for a large sponsor. Who has, I think, 10 deals that are not distributing. And I'm just curious. I saw they were raising equity for 3 deals that they say they owned already. So I got, my antenna up. I'm like, all right, they're trying to raise rescue capital, preferred equity to rescue their own deals so that they as a sponsor don't have a foreclosure on their record. But again, they're putting the existing LP investors in the back seat. So I get on the phone with them and I was direct. I said, I understand you have all these deals that aren't distributing. He says, the interest rate caps are expiring. We need to buy new ones. And I'm like, so what has all this taught you? I expected to hear you need fixed rate financing, or you need less leverage, or you need to expect these things. The answer was, we need to control the supply chain for renovation, and we need to have container loads of kitchens and bathrooms and countertops and flooring so we can renovate the units in a timely manner and control costs. That's what I heard from the guy. I'm like, okay. And I recorded it because the beautiful thing about being in New Jersey is we're a one-party state. I can record and I don't have to disclose. So this way, I'm not going to mention the sponsor's name, but I could. And absence of malice is nothing they could do legally.
Right. Oh my gosh. So with the amount of experience that you have, and I love that you started out, if I heard you correctly, you were doing auditing. So you can really,
Yes.
you're pulling that thread, right? And going all the way back to the beginning of where someone could start off in the wrong foot or where they went wrong possibly in their investment or their financial analysis. What has it been like over those past 30 years? Are you seeing trends coming back? Are we in a market cycle? What happened in the past that we can learn from today?
Well, we're seeing, I guess a lot of the issues that we're seeing with what you read about maturity defaults and even major funds walking away from properties. I think that the interest rates were historically low for too much, very long extended period of time, too long. And that just made everybody think they were invincible. And many years ago, interest rates and capitalization rates moved together. And then cap rates kept compressing, going down as well as interest rates go up. And everyone's like, well, this is the new norm. And I'm like, doesn't sound right. And, for us, we don't buy a deal unless we believe we can generate cash flow in the first year. So I'm not buying on a 5 cap and financing on a 6.5 per se. For me, it's got to be at least the other way around. All right, I may not have a lot of cash flow in the first year until I improve it, but I want some. And that's why when we look at our investment thesis, the number one rule is don't lose money. It's okay if you don't make a lot, but don't lose the principal.
Yes.
And so what we look for, and this has taken time, what we've looked at, because we used to do a lot of value adds apartment when money was cheap. But now I like to know what this cash flow, and I like to know that if I can't sell it and I have to hold it 10, 12, even 20 years, that there's always a very good, healthy cash on cash return. And I once spoke on a panel and I said, what would be a bad investment? I said, well, I bought a deal. I thought I was going to move the rents and I was going to combine units and I got 8% a year for 10 years and I sold it for my purchase price and I didn't make any money. And people like, hey, that is terrible. I'm like, no, it's not terrible. I got 8% a year for 10 years. Plus, I got my principal back. Plus, I got depreciation.
Right.
I'm like, what's
if you've
so bad
been through a
about that?
bad deal, that's not a bad, if you've been through lots.
Exactly. A lot of people say, oh, it's a terrible deal. You got 8% a year. I said, yeah, but I didn't lose my principal. That would be a disastrous deal. And most people think of a bad deal as where you lose money, not where you break even. And I think that's part of the mindset. I think an investor should be eyes wide open and say, what if I can't sell it as a profit? Am I satisfied with the current cash return over a period of time? What period of debt should I take? Because the worst thing that can happen is you have a capital markets event where you have to figure out how to refinance. And if it's something you're running yourself, you can't actively manage it properly.
Right.
So we always, I don't have a crystal ball. So I like longer term debt. I'll worry about a prepayment penalty. There's always somebody with a 1031 exchange who doesn't care about your existing debt.
Right.
And because of that, the ideal investment gets 50% of the return from current cash return distributions, and the other half is from appreciation, moving the rents.
Yeah.
And I guess the last 5 years, we've focused primarily on multi-tenant industrial and flex properties. And we've always had them, but mixed in with everything else. And we're very happy we did that. And we sold pretty much almost all the multifamily except one going into COVID and through COVID. During COVID, all the industrial paid, even the small tenants. Where multifamily, people didn't pay. Even if you were remote and you were working at home and you were getting paid, you took advantage of the system and you didn't pay your rent because you knew you couldn't get evicted. So people gamed the system. Or as Barry Sternlicht from Starwood would call them, sport defaulters. Some people, just because of the timing and everybody else has problems on their loan, if you were the property owner, you might put your to default because it was a social issue where the lenders couldn't foreclose in mass on everybody.
Right. Oh my gosh.
And tenants, I know people that did the same thing, paying rent in their apartments.
Yeah.
But we're always able to find a deal and get positive leverage, and it's all about the cash flow. I wouldn't mind owning some of these forever, although that's not the plan.
Right.
And also, if you're going to invest with somebody else, make sure they have real money in the deal. Some sponsors I've seen take tremendous fees. And although for us, the fees really run the office because they also pay for among other things, the office personnel. They also pay for deals that die where I don't ask you to pay for my due diligence costs, even though you're going to invest. So we don't make money on that. It just covers overhead.
Sure.
But then we have meaningful equity alongside our investors to make sure there's a proper alignment of interests.
Nice.
We provide timely financial statements, typically quarterly, because with commercial assets, nothing really happens on a month-to-month basis. You have contractual leases that might be 3, 5, 7, or 10 years, and the rents go up 3% a year or more, and nothing really happens. And if there's something newsworthy in between reporting periods, we'll send out an email. So it's what we call boring. They're really boring investments. They just generate cash flow, and we move the rent. Seriously, you're laughing, but they're boring.
Yeah, no, I always say this all the time. I love boring. I live for a boring life because I think when you make real estate is a get rich slow type of, strategy. And I love what something you wrote in the notes before the interview is the tortoise always beats the hare. Right. If you have a slower strategy, but it's about making money at the end of the day or not losing money at the end of the day. Erwin, can I kind of bring it back to basics a little bit? Because
Sure.
a lot of our listeners are new or interested in real estate, and a lot of the terms that we're throwing around may be new terms for them. So could you help us go through capitalization versus cash flow versus cash on cash return? What do these terms really mean in layman's terms?
Sure. In the very basics, the cash flow, or net operating income is your income available before debt service and any lender required escrows for like tenant improvements or leasing commissions on commercial or replacement reserves if you're doing multifamily. The cash yield would be the amount of money that's left over as a percentage of the equity invested after the mortgage. So if you're going in, even though you might be buying we call it 8 cap, and that would be the price, the income divided by the price is how you would get that. You may not get that same yield after debt service because you also have closing costs and other reserves you need to fund.
Yeah.
Most sponsors typically advertise for investors based on what they call an IRR, which is an internal rate of return based over a period, a time period of money, how long the money was outstanding, how fast they paid it back, and how big the return was, a multiple. Did they double the money, triple the money? That would be the equity multiple. Still, what people don't realize is the shorter the hold period, the higher the IRR is. And when sponsors know that things aren't going to work out on a long-term hold and they want to cut and run because they maybe see a default down the road, they're going to sell short in a shorter period of time because it boosts their IRR where they make their money. We look at deals as if we're going to hold them forever. And if I could ride out the bump in the market because I have maturity, extra years on the debt, like for example, we have one multifamily deal left in Virginia Beach and I have 4 years left on the loan. If people want to buy it, I'm like, well, I'm in no hurry. Here's the number. If you hit the number, I will sell it. Otherwise, I'm prepared to ride it out the next 4 years, 4.5 years as the Federal Reserve reduces rates, the value will go up.
Right.
And people keep saying, well, look at all the locked up equity you have. I'm like, so? I'm very patient. What real estate investors, especially newbies or people wannabes, have to realize that it's time. Time has a way of curing almost everything. So if you stay in it long enough, you will make money. That's how, if you look at all these family wealth was created through real estate. It wasn't by investing in an apartment deal, renovating 30% of the units and selling it 2 years later. It was through a long-term hold strategy where as you increase the income, you can refinance, pull cash out, continue to hold, and as you refinance, it increases your cash on cash yield. And that cash that you refinanced out is tax-free. You can buy something else with that or invest it in something else and compound the income. And that's really how you're going to create wealth. And so like we have a deal in the market now where we're raising money from accredited investors. And everyone says to me, well, I see you have a 5-year business plan, but you have 7-year debt. What is really the plan here? Because I also give my investors the benefit of a 10-year cash flow projection, just so they can see where it's going.
Yeah.
And I said, look, we have a financing from a life insurance company. It's very flexible. And at the end of year 4, we may go talk to the life insurance company because they'll waive any prepayment penalty. And if we could refinance and pull out cash and de-risk your investment 25 or 30% and reduce the rate, by a significant amount, which boosts your cash return, wouldn't you want to hold the investment? And everyone says, yeah, cash flow is good, especially if we can refi cash out. We would stay in for the 5 or 7 years. I said, okay. And because we have a flexible prepayment penalty at the end, somebody will make us a crazy offer and we'll sell it. And I'm explaining to people because they look at some of our existing assets under management, some of the stuff we've held 7 years, 10 years, 12 years. And it's because our existing investors like the cash flow.
Right.
Even some of our sort of quasi-institutional capital partners, we've had offers on some of the industrial, and they're like, we like that we're getting 11% on our money. They must have some, everyone's got a bad egg in the basket. So this sort of helps it when you have the cash flow. And we're very patient. I invest my money personally with the investors as well. And I like knowing I get a check every quarter. I like the distributions. I'm in no hurry to sell. There's enough depreciation to cover more than my preferred return. And I'm very happy to make it slowly. You think of wine. New wine is cheap. As it ages, it creates a lot of value. And so over time, you look at these Bordeaux's that are 50 years old, they sell for big numbers.
Right.
And along the way, we would have refinanced once, twice, maybe 3 times.
Yep.
I understand that some investors knowing they're going to get a big chunk of change, but then there's a tax issue and a recapture of the depreciation. So it sometimes just is better to hold and not have to worry about any of those issues.
Sure.
So we're very conservative in what we do. We don't leverage more than 65%. And as a new or potential investor, that leverage is great. If you can get 80 or 90%, that's great when the market's going like this. But when the market's going like this, that'll cut you twice.
Yeah.
And I don't think anyone wants to be trying to catch a falling knife because you're really going to get hurt and you're going to lose a lot of money.
Yeah. So can I repeat back to you a little bit of what you've just said, just kind of to summarize? And I want to make sure I'm understanding this too. So if you have the long-term buy and hold type of exit strategy, cash flow is going to be more important than the IRR. If you're saying the IRR is that measurement of time, if you're looking for a shorter exit strategy, is the IRR more important at that point? If you're looking to get out in 2 or 3 years?
If you think you only want to make, first of all, everybody tells you it's a 5-year investment. It's always the IR pro forma IRR is based on typically a 4 or 5 year hold.
Got it.
The question is how much of reserves are built into the capitalization? Is the sponsor taking into account of operating expenses going up 4 or 5%, as we all realized the last couple of years? How much flexibility is there? Is the overleveraging? And I'd rather bet on the tortoise than the hare, especially where we are in the cycle now. And we're looking at anything we buy this year or next year, as a 5 or 6 year plan when the Federal Reserve hopefully becomes more normalized, and then we'll have a lot of options for us and the investors on what we want to do. And we also don't raise funds because this way, you don't have good deals protecting bad deals and vice versa. But we do it also because people that are very focused on tax avoidance, we do a lot of 1031 exchanges. By doing raising capital on a deal by deal basis, I can also admit an investor who has a tick from an exchange of their own as an investor in the new deal. So it helps me raise equity. It helps investors find a home. And every time I talk to somebody that's selling something, they dread doing a DST, a Delaware Statutory Trust, because you don't really know what's going on there. You can't really get at what you want. Not that I have liquidity in my investments either for them, but they like to know they can pick their sponsor and their investment, and they're not forced into something because they have a tax problem.
Nice. I really like your strategy, not over leveraging, really focusing on safe, consistent investments, and then something that can survive the downturn of a market. Because if you do have that cash flow, right, and if you're not on adjustable rate mortgage, you can survive a downturn as long as the rental rates or the market that you've invested in is a strong market to start. And we're not going to see that be so turbulent. But can you we talked a little bit before we started recording about what you're seeing others that have made kind of big mistakes over the past few years, or what have you seen that maybe that was a bit of a scary trend
for investors that may be coming to bite them as we get into this new world?
I see a lot of investors who went into syndications that use floating rate debt, and even though they could have purchased a longer term interest rate cap, they didn't. And so they have to replace it. And so maybe those deals are not distributing, or maybe they're selling them because the sponsor doesn't know what the future is bringing. And you have a lot of sponsors saying it's all the Federal Reserve's fault for increasing interest rates. And it's interesting when you read some of these investor newsletter, they say, well, it's the Federal Reserve's problem that they moved interest rates. It worked against us. Oh, the contractor wasn't good. We had too much delays. Oh, operating expenses. The county raised the real estate taxes a lot more than we thought. Oh, we can't hire good staff. We have to pay them a lot more. And then again, I look back at a lot of these things. Well, you have to assume expenses are going to grow 3 or 4% a year, not 1% a year. And it's just common sense.
Absolutely. Especially with the property taxes, right? I
Yeah.
think it's so funny how people are so surprised and say, well, did you not see the jump in appreciation over the past 3 years? What did you think was
Correct.
going to happen?
Especially coming out of COVID, where every state and local government expended, but it's a lot of money on behalf of COVID for their residents, and they had to recoup it somehow. Should have
Exactly what we're
expected
seeing
it.
here in Vermont, Vermont, especially when it comes to the property taxes, we already have very high property taxes, but pre-COVID, an average single family home was 225,000. Now average single family home is 375, 400. And that was a market corrector really for our area. That jump is extreme. But assessments are coming out now, and property owners are looking at between a 10, 15, even 20% increase in their property taxes, something that's already very high. And so it's a big discussion that people are having now. And I think about those investors who are facing the same kind of thing, but you can't base your future on what's happening now. And is
No,
that
you
part of
can't.
your analysis? Say, how do you do your financial models to, anticipate these kind of things?
Well, you have to anticipate them if you're in commercial as opposed to office or retail and multifamily, because by and large, those are not triple net leases, meaning that the landlord does not bear the increase of the operating expenses. Luckily, with what we do, all the tenants bear those increases. First of all, insurance didn't go up as much on industrial as it did on apartments, where it could have tripled. I don't have to worry necessarily on a lot of direct payroll costs, like with a full staff as an apartment building or an office building, things like that. But if my insurance went up 3%, taxes went up 5%, the tenants pay all their own utility. That's the beauty of a triple net lease, where we're insulated against a lot of that stuff. And so, all right, maybe if the market, the economy slowed down, all right, I couldn't get big increases on renewals, but I can get the tenant to sign for another 5 years with 2% increases, but I didn't get a big bump in between. That's okay. I keep it full and I keep it cash flowing.
Yes.
And it's like a game of chess, just keeping all your players on the board, type of thing.
Right. Don't lose money, right?
Right. Don't lose money. It's okay that I couldn't get an increase, especially if I have fixed rate debt. But when it's a triple net lease, every nickel really goes to the bottom line. And here's a great analogy. If you have a 10-year lease and rent goes up 3% a year, take your body weight, compound it 100 times 103 times 103 for the next 10 years. Tell me how much weight you gained. So the appreciation is built in before big rent bumps in the market. And that's what people have to understand is, I think that if you're scared, don't do multifamily. Find something that's primarily cash flow driven, and you're beating the treasuries, like the deal we're raising capital for now. I think they'll distribute 7.5 in the first year. The treasury is 4. And plus you get depreciation. So think of what your alternatives. If you bought a CD in the bank for your 50 or 100 grand, you're going to get 4 or 4.5. All right. You have no risk. It's got full faith and credit of the government. It's okay for an extra 300 basis points. That's your risk premium, but you're also getting the tax benefits. Right. It's not really hard to understand, but I understand that with all the bad news in the media, that anyone who has not been an investor up until now is scared.
Yeah.
And even a lot of the existing investors are scared. Like I had one investor who was going to invest in our latest deal. And he called me and goes, I can't do it. I just have 3 capital calls on 3 other deals. I said, it's okay. I'd rather we be friends. I'm not hurt. Trust me, I understand you're worried. And he told me a story about another deal that went to foreclosure last year and he lost his money. And what investors don't understand is when there's a foreclosure, you also could have phantom gain. You have the recapture. Sometimes you have to make up the depreciation write-off and you don't have the income. And if the lender issues a 1098 for forgiveness of debt, you have phantom income and you don't have any money to pay the taxes.
Oh my
If they write down the loan, that's forgiveness of debt. And I know when people have had that on their homes sometimes where the market value fluctuates, and even though they're current with the loan, but the lender can't have loans that are upside down on their books, so they'll write off part of the debt. And they'll send you a 1098 for forgiveness of debt. All right, as a primary residence, you don't worry about that. You just adjust your basis. You don't have a taxable event. But if it was an investment property, you would have a taxable event.
Wow. I've never really thought about that part of it, but yeah, it's a really good point that you make. Again, I think it's just coming back to your principles of investing. It's about not over leveraging, not going into when you said a term floating debt. Could you explain what that means?
The floating rate debt is variable rate debt. You could think of prime. Prime moves with the Federal Reserve. It used to be LIBOR, the London Interbank Offering Rate. Now we went to SOFR, S-O-F-R, which is another floating rate index. Means your interest rate could change, month by month, could go up or go down. And that's why people buy interest rate protection. So there's a maximum ceiling. Your rate won't go over a certain period. But if that cap expires, then you're subject to the full market index.
Wow.
So I think of it on single, when people did adjustable home loans.
Yep.
Although there might have been a maximum adjustment on an annual basis, but where was the top? How high could it go? And as it went up, could you afford to make the debt service payment? All right, single family, your own home is a little different. You can't do it. But even on a commercial property, you're only getting so much rent under your leases.
Yeah, that's right. And then that can only go so high as well. Even when you've got really, in our market, we have extremely high demand. People are desperate for housing, but we have a median income that's less than $50,000 a year. So there's a cap at what people can pay, even though the demand is really high. So you can't just keep raising rents and raising, thinking you're going to be able to fill that. Or at least maybe you can fill it, but they're not going to be sustainable. They're not going to be able to keep up that payment for the full year of the lease. And now you've got tenants defaulting because you put them in because you needed to hit that first cap. Maybe you get desperate too. And so everyone can make that first in security to get the lease if they're really desperate, but can they keep it? And especially now, are you in a state that has very high tenant protection laws where it takes you a year and a half to get somebody evicted for non-payment, which is what it is in Vermont?
Same thing in New York. Yeah, I understand that. So there's a lot of things have to be taken into consideration. Even if you're investing with someone who's done a few deals and other people that have invested with that sponsor and they've made money, is you have to figure all this out for your own. Don't rely on your friend or your cousin or your coworker. You should ask the right questions. That's why I like boring. This is what we do. We manage the assets in-house. We have a full team that does all this homework. And the one thing we've really focused on, and it's really helped us in probably the last 5 or 6 years, is I guess in multifamily, and I've had some multifamily investors call me that want to look at industrial, and I could tell by their questions they don't understand commercial. They understand apartments. And with apartments, you're always looking at what's the rent comp? What are the other apartments renting for? What are other buildings selling for on a per unit basis? And although we look at rents, I don't really care about sales because there's a lot in a sales price. And for industrial, it'll be per square foot, not per apartment, that you don't really have the data on to know why it's sold for more or less than what you're looking at.
Right.
I'm looking at replacement cost. I know that like our current transaction, I'm buying a deal for $59 a square foot. I know to build that building is $110 a square foot, plus the money you'd have to pay a real estate broker and a leasing commission to lease it for you. So your rent needs to be probably 50% more than mine, and maybe you break even.
Right.
So we look at things a lot differently like that. I look at replacement costs, I look at barriers to entry, and what really interests us is what goes on in the tenant's business. And so we ask a lot of questions. I don't, as other people look at comparables and want to go tour, the competing assets and what do they rent for. I want to know, what is your sense of family and community? How long have people been here? How many people do you employ? What's the average commute time?
Wow.
Because that tells me whether you can pick up and move 30 miles in another direction to save $1 a square foot in rent. Because people are not going to commute the extra distance. People are looking to hire, especially in a lot of these warehouses and assembly places, and they'll get a job for $1 an hour more down the road than have to commute an extra 35 minutes.
Yep.
So
Such a good point.
Yeah, and you don't really realize that. Like we
Yeah.
bought a deal June of last year. We don't do a lot of single tenants because there's risk associated with only having one tenant in a 700,000 square foot building. But when we asked the questions and we found out they employ 500 people in 3 shifts, and it's a 24/7 distribution center, they can't move more than a mile or two because those people are not commuting. They may get some of them to commute a little further, but it's a major industrial area. They're not moving. And so the lender actually gave us a 10-year loan, and there's only 6 years left on the lease because even the lender laughed at it.
Wow.
And the current opportunity we're raising capital for, I have a tenant who's been in the building for 22 years. The building was built for them, but it's a German publicly traded credit tenant. They only renew 3 years at a time, but they have 100 people in 2 shifts. They'd love to hire more people.
Mm-hmm.
And the average tenure is 12 years, and the commute's 15 minutes. So it's how sticky your tenants are. That's one thing. If you're going to look at a building, people should also ask about the business, not just look at the rents and the income and comparables. Find out about the business. Find out about the health of the business. How cyclical is the business? How is the business performing? Because this way you have a little insight into, is that tenant going to stay?
Yes, I love what you're saying. And this is really like gold, for anyone listening right now that is considering putting, into their first syndication, or they've maybe been approached by a sponsor. There's thousands and thousands of sponsors out there, right? There's so many people trying to raise money for real estate deals now. But, asking these questions, it's about the deal, but it's also, like what you said, about the business. And it's about being in alignment with the people that you're going to be working with, and if you're coming into something and you want a guaranteed kind of return, maybe it's not going to be as sexy or as fun or as crazy as some of these other deals these sponsors are raising money for, but you have to ask them, are they asking the right questions? And what I'm really getting from this interview is, if you are interested, if I were to be looking at a sponsorship, I want to be working with someone like you who's asking more deep, in-depth, creative questions, more getting a bigger picture of context so you can really understand the full picture of what you're putting your money into. Because I've seen it all, a lot of the times you hear people, they'll promise you the world, right? What you're going to get for your money. But if they're not asking the right questions, your money could be gone.
It's true, especially with apartments. They focus on rent sales and rent comparables and apartment comparables. Look at all the public data out there. You'll see how rent growth has gone like this, but income growth is sort of skipping along. And how sustainable is the business plan where you're going to keep moving rents in apartments? You have to have a lot of turnover, a lot of vacancy to try to find people that can afford them. And then the funny thing is, I actually looked up one deal on some of the data services. I was curious to see how many times it traded hands in the last 15 years. And it was quite a few. And everybody's had the same business plan. We're going to renovate. We're going to move. How many times can you change kitchen cabinets and a granite countertop? And put in a low flush toilet to save water, or a digital thermostat. It's like, if anyone tells you it's an all original apartment building, I call bullshit, because I don't think it exists.
No, definitely not.
You might. There are some mom and pop operators that just didn't care. There are some, but it would be like finding a unicorn.
Yeah, absolutely right. Exactly. And I think with real estate, if you're looking for these unicorns, you're looking for the fast, easy money, the thing that you're going to become rich after one deal. That doesn't exist. You have to put in time, effort, work, build your systems, create your good partnerships, network with the right people. So to wrap up our interview here, Erwin, our listeners, if they want to reach out to you, find out more about you, what's the best way to reach you?
Sure, you can put my name into the search bar at Google. I'm highly searchable. IRWINBORIS, Irwin Boris. You could email me at irwinboris@gmail or irwin@heritagecapitalgroup.net. Easy to find, and I'll answer all your questions. And if you have an interest, you want to look at industrial and just see what we do, we're fairly transparent and happy to share with you our stories and what we do and what we own. And again, it's the tortoise that always beats the hare. That's the way we look at it.
I love, there was so much good stuff in this episode. I feel like this is one that I'm going to listen to a few times over because there was a lot of great questions as well as examples of different ways to look at deals financially. So thank you so much, Erwin, for being on our show. And I hope that you come back on again soon.
No, this was fun. I hope the listeners appreciate it. Hopefully you learn a little something. That's what we're out to do, is to educate people. I believe in giving back. And if anyone has any questions about an existing investment, feel free to reach out.
Okay, fantastic. Well, thank you again, Erwin, and thank you to our listeners. This is the Failures to Fortunes podcast, and I'm your host, Kate Berry, and we will see you next time.
Thank you for joining us on another episode of Real Estate Investing Failures to Fortunes podcast. If you enjoyed today's stories and insights, don't forget to subscribe, rate, and leave a review. Your feedback means the world to us. Remember, your journey in real estate is a marathon, not a sprint. Embrace the failures, learn from them, and turn them into your stepping stones to success. I'm Kate Berry, and until next time, keep hustling, stay inspired, and keep turning those failures into fortunes. Happy investing.